What does it really look like to manage risk during a crazy, volatile month in the crypto markets? Well, we're about to find out. In this explainer, we're going to break down a real month-long trading campaign that used a super powerful strategy called static hedging. We'll see how it was set up, how it held up under pressure, and, if it actually made money. This is it. This is the big question, right, for any trader. If you can't possibly know where the price is going tomorrow or next week, how in the world do you build a strategy that works? The answer? Well, it isn't about having a crystal ball. It's about having a plan to manage risk no matter what happens. And that's exactly what we're going to dig into today. Now, you might have heard of dynamic hedging. That's the one that uses futures, and you're constantly tinkering with it. It works, for sure, but it can be kind of fragile. Static hedging, what we're talking about today, is a whole different animal. Instead of futures, you use other options as your hedge. What does that mean for you? Fewer adjustments, probably lower trading costs, and here's the big one. It handles those sudden, crazy price jumps way better. So let's set the scene. It's early March 2024. The general vibe around Bitcoin is pretty bullish. You've got strong ETF inflows, the halving is right around the corner. So the goal is to sell some option premium and take advantage of that environment. But, and this is key, without taking on that scary, naked, unhedged kind of risk. At its heart, static hedging just lets us do something really powerful. We can sell puts to collect income, but we do it with a built-in safety net. We're literally using options to protect our other options. It's just a really smart way to define your maximum risk before you even put the trade on. In this quote, this gets to the absolute core of the mindset you need. It's not about ego, right? It's not about pretending you're some kind of market wizard. It's about being humble. The second you admit you can't predict the future, you're forced to focus on the things you actually can control. And that's your risk. This whole approach, it's not about getting rich quick. It's about making sure you don't go broke on one bad call. All right, enough theory. Let's get into the nitty-gritty and see how this thing is actually built. We're going to start with the absolute simplest form of a static hedge, just to get the ball rolling, and then we'll build up the complexity from there. So, the first tool out of the toolbox is a bull-put spread. Now, I know that might sound a little complex, but it's really not. Just think of it like this. You're selling a put option to somebody, collecting some nice income for it, but at the exact same time, you're buying a cheaper put option just a little further down the ladder. And that cheaper option, that's your insurance policy. It's your safety net. It caps your maximum potential loss. And that's really all it is. Just two simple steps. You make a sale to bring in some premium, and you make a purchase for protection. The result is a position where you know your risk up front. And the best part is, you don't even need the market to go to the moon to be profitable. You can win if the price goes up, if it goes sideways, or even if it drifts down just a little bit. So the first real trade on the books was a 60,000 bull put spread, expiring on March 15th. Now, those strikes weren't just picked at random. They were inside the expected move. That's kind of the range the market thinks the price will stay in. So they offered pretty good premium. And on top of that, the price had recently shown some really strong support right around that 62K level, and if all that failed, well, that's what the 60K put was for, the safety net. Okay, so after that first trade was on, we added another layer to the position. Instead of buying our protective put for the same expiration date, we can buy it for a later one. This little trick creates something called a diagonal spread. And here's why that's so cool. That longer dated hedge gives you a ton more flexibility. It lets you sell multiple short-term puts against that one single long-term piece of protection. And of course, it's like clockwork. As soon as the positions are nicely set up, the market decides, you know what? Let's test this guy's resolve. This is really where a strategy proves itself. Not when everything's going your way, but when the market moves against you. So after just tapping new all-time highs, the market turns on a dime. Bitcoin takes a pretty sharp dive in the middle of March. And by the 19th, that drop has put our short put at 65,000 under some serious pressure. This is it. This is the exact moment a strategy like this was designed for. This is the moment of truth. That short 65K put is now in the money. All that means is the market price is now below our strike. If it expired right now, it'd be a losing trade. So panic is an option, but it's not a good one. The position is under fire. What's the move? The answer isn't to just give up and close everything for a loss. No, it's to actively manage the position. And this is where we pull out maybe the most important defensive tool an options trader has. We're going to roll the position. Rolling, it sounds fancy, but really, it's just an adjustment.
You're closing out the position that's in trouble, and at the same time, you're opening a brand new one that gives you more room to be right. You're essentially moving the goalposts, pushing your strike price further away from the action and buying yourself more time by moving to a later expiration date.
And here is exactly what that looked like. First step, buy back that 65K put that's in trouble. Just get it off the books, close out that immediate risk. Second step, at the exact same time, you sell a new put. This time at a lower strike price, 63K, and for a later expiration, April 5th. You're just reestablishing the position, but on way better terms.
And here's the absolutely brilliant part about rolling correctly. Not only was the risk successfully pushed down and further out in time, but the entire adjustment was made for a net credit. Think about that for a second. The trader actually got paid to improve the position and increase its chances of winning. That's a calm, logical, and profitable move, all while under pressure.
Okay, so now let's get to the good part, the resolution. After navigating that pretty stressful period with a clear plan, we can finally see how the whole month-long campaign actually turned out. Just a couple of days after that roll, the market bounced. And thanks to those adjustments we made, the portfolio was perfectly positioned to benefit. As the different expiration dates rolled around, all those short-term puts that we had sold just expired worthless. And in the world of selling options, that is the perfect outcome. It means we get to keep all the premium we collected earlier. And, the proof is in the pudding. The account started the month with 0.2541 Bitcoin and ended with 0.2589. It's a clear, quantifiable profit. And it was achieved not by predicting the market's every little wiggle, but by systematically managing risk through a pretty significant dip. So let's do a quick recap of the tools we saw in action. We started with the basic vertical spreads for our simple define risk trades. We added some flexibility with diagonal spreads for those longer-term hedges. And most importantly, when things got tough, we used rolling to calmly and effectively defend the position. So we've just walked through how to manage risk on a week-to-week basis. But this kind of opens up a much bigger question, doesn't it? What if you could build a single hedge structure that protects you for months at a time, letting you sell options against it over and over again? Now that is where this strategy gets even more interesting, but that's a topic for another explainer. Thanks for watching.